Welcome back to Investing Talk Podcast.
Today, we're looking at 374 Water.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This company is, it's a perfect case study in that high-risk, high-reward profile.
Definitely.
We are talking about a potentially transformative environmental technology. I mean, one that promises to solve some of the world's most toxic waste problems.
But it's colliding head-on with the harsh reality of commercialization.
The very capital-intensive reality.
Okay, so let's unpack this, because there is genuinely good news in here. If you look at Q3 2025, revenue was up significantly.
Right. Year over year, it hit $760,000.
And this wasn't just theoretical. This jump was driven by actual service revenues.
From their commercial scale projects, they are deploying the product.
And they've got that huge institutional validation, right? The Department of Defense partnership.
At the Clean Earth facility in Detroit, that's a massive proof point.
It is.
That operational success is the entire foundation for the long-term bull case.
Okay, but then there's the other side of the coin. The financial trade-off for all this progress.
And it's immense. While revenue grew, the net loss widened a lot.
So how much are we talking?
In Q3 2025, their net loss was $4.3 million.
Wow. And that's up from what, 2.7 million the year before?
Exactly. And that burn rate is all from higher commercialization costs, aggressive R&D, and, well, inflation.
And here's the number that I think just shocked the market and triggered that sell-off. Management's guidance.
Oh, yeah.
They projected full year 2025 revenue of only about $4 million.
Which, when you compare it to the analyst consensus,
it's a disaster. Consensus was sitting closer to $27 million. That is a $23 million shortfall.
It's catastrophic by any measure. And the market, it just doesn't forgive a miss of that magnitude.
Not even close.
It suggests this fundamental disconnect, not on the technology, but on the pace.
The pace of converting that pipeline into actual revenue.
Right. The market expected them to realize revenue about 7 times faster than management now thinks they can.
So that immediately makes me question the spending. Operating expenses were up 64% year over year.
They were?
Are they spending that money efficiently?
Well, they're betting that they are. That surge in expense is dedicated to R&D and expansion to accelerate that pipeline. For instance, they're going after projects in North Carolina.
And that's specifically for processing AFFF.
It is.
Can we clarify AFFF for everyone listening? That's aqueous film-forming foam. Why is that specific waste stream such a big deal?
It's critical. AFFF is this highly concentrated, very toxic material. You see it in military bases, airports, anywhere they fight jet fuel fires.
So it's a huge source of PFAS contamination.
The most immediate, non-negotiable problem. These are high-margin cleanup jobs that governments have to address now.
So that's where 374 Water sees its quickest path to scale. Okay, so they're chasing the right work, but it takes cash, and more cash. And that brings us to the biggest pressure point for me. Liquidity.
Absolutely. The cash situation is the single greatest risk.
How bad is it?
Cash reserves plummeted. They were down to a very concerning $100.9 million by the end of Q3.
And that's down from over $10 million just 9 months earlier.
Yeah, a huge drop.
So that demanded immediate action. And they took it, right? They used that at the market facility.
Yeah, ATM, yeah. They successfully raised about $7.0 million in Q4.
Okay, that sounds good. But if their quarterly loss is running at $4.3 million, that $7 million buys them what?
A quarter and a half of breathing room. You've hit on the core issue.
So this is not a safety cushion.
No, it's a tactical sprint. They've bought themselves a runway that's only forecast to last through Q2 of 2026.
They are betting everything on major contracts landing before summer of next year.
That's the bet.
Which makes the balance sheet look incredibly fragile. Is there a mitigating factor here, something that gives them flexibility?
There is one, and it's a big one. They have zero long-term debt.
Okay, that's huge.
It's an enormous advantage. It means every dollar from that ATM raise and all new revenue can go directly into deployment and scaling.
Not servicing liability payments.
Exactly.
Yeah.
That flexibility is crucial on such a short timeline.
Okay, we've set the dire financial timeline. Let's shift to the tech that justifies all this risk. AIR SCWO.
Right. AIR SCWO stands for supercritical water oxidation.
What does that actually mean?
In simple terms, it uses water above its critical point, like a superpowered solvent, to just instantaneously destroy PFAS and other hazardous waste.
So it's destruction, not just removal. That's the key.
Precisely. It permanently eliminates these forever chemicals. It's the kind of final solution you need when governments are mandating total destruction.
That sounds like a powerful moat. Are they really a first mover here?
They are. In this specific niche, for a scalable, mobile, commercially viable system for this kind of waste remediation, yes.
So that specialization gives them an edge against, say, bigger companies using older incineration methods.
It does. They're establishing category leadership early on. And we see that being confirmed by their service contracts and those federal engagements.
Okay, so if the tech is so valuable and the regulations are pushing everyone this way, why hasn't a major player, a Veolia or someone, just scooped them up, especially with the stock near its lows?
That is the million-dollar, or I guess multi-million-dollar question.
Yeah.
The market is valuing the execution risk higher than the tech potential right now. Maybe the big players are waiting for more proof of high-volume deployment before they write that check.
But that calculation could flip overnight.
Instantly.
Speaking of volatility, let's look at the charts. After that revenue miss, what's the price action telling us?
Well, the short-term picture is clearly negative. The stock is trading near its 52-week lows.
Around 36 cents.
Yeah, around there. And it's dropped over 50% since its high back in June. It really reflects the market's caution.
And that volatility is captured in the analyst projections, isn't it? A remarkably wide trading range.
It is. It indicates extreme price sensitivity to every single piece of news. You have to be comfortable with a lot of movement here.
You absolutely do.
But there is one little contrarian technical signal that suggests a glimmer of hope.
Okay.
The stochastic RSI. It is technically oversold. It's clocking in at 0.23.
Let's break that down. For someone who doesn't live in technical jargon, what does an oversold indicator at 0.23 actually tell us?
It means that, technically speaking, the selling pressure might be exhausted at these levels. Think of it like a coiled spring.
Okay.
The fundamental news is bad, but the technical signals suggest the stock is kind of emotionally spent, and it might be poised for a short-term relief bounce if the news improves even a little bit.
And that kind of aligns with the long-term optimism we see from analysts, right? The 12-month price targets are centered around $1.78.
They are, which represents a potential upside of nearly 400%.
It just underscores how binary this investment is. Either they fail to commercialize and it languishes, or they secure contracts and the stock re-rates instantly.
It is pure growth speculation.
Yeah.
It all depends on catalysts over the next 3 to 6 months.
So let's talk about that tactical sprint. What are the key events we need to watch?
The two biggest are tied to reporting. The Q4 2025 earnings announcement, that's due in February 2026.
And the guidance call after that.
Yes. We need to see that revenue trajectory accelerating and that they're getting margins under control.
Because if they're still burning $4 million plus a quarter, that Q2 deadline approaches very, very quickly.
It does. And externally, we're watching for institutional buy disclosures and ETF rebalancing.
That could provide some much-needed liquidity and shift sentiment.
It really could. And beyond the calendar, you have the speculative drivers, the rumors.
New awards from federal agencies like the DoD.
Exactly. If that's validated, that's immediate revenue acceleration.
Yeah.
And then there's the M&A talk always bubbling under the surface.
A strategic partnership with a larger industrial firm would be rocket fuel.
It would, but the biggest macro driver, the one that's almost a certainty, is regulation.
More tightening of controls around PFAS waste, new EPA rules.
Right. That could create a sudden, massive, non-negotiable demand for their destruction services globally. That regulatory pressure keeps refilling the pipeline no matter what.
Okay.
So to tie this all together, this is the definition of a binary investment. The prospects hinge entirely on the speed of commercial revenue and execution before that mid-2026 liquidity wall is hit.
So it supports both short-term trading and maybe some patient long-term exposure.
If you recognize the short-term reality of potential dilution and cash drain, yes.
The essential question here is whether 374 Water can convert that growing pipeline fast enough to establish true category leadership before they need to tap the capital markets again.